So this is an extremely important video. So please pay attention carefully to what I am saying here, because in this video, I'm going to talk about two concepts: risk management and flexibility, using the chart of Tata Power somewhere in the month of March. So I'm showing you an old chart as per the SEBI guidelines. So have a look at this base. Okay, let me draw this base and you will immediately notice problems in this base. Okay, if you have been watching my videos in the recent past, you will immediately notice some problems in this base. Okay, and I will talk about those problems. So one of my students in my video course asked me a very fantastic question, and I'm making this video in response to that question. That question inspired me to make this video. Okay, so I want to thank my video course student for asking this question. So the question is this: I had included the chart of Tata Power, this particular base, in my video course, and I mentioned that the high of this candle is the buy point. So have a look at this. I will draw the point 1, point 2, point 3, point 4, and point 0.5. Okay, so we need minimum 4 points in the base, correct? So there are 5 points in this base. We need minimum 10 candles in the base, so there are 10 candles in the base, and we need volume contraction inside the base, which you see here. Okay, so this meets our criteria. But the question is this: I have also mentioned that whenever your buy point is in the blue zone, preferably the latest closing price should also be in the blue zone. Another thing I had mentioned is whenever the buy point is in the blue zone, we expect at least 6 candles in the base, correct? On the other hand, when the buy point is in the green zone, we expect the closing price to also be in the green zone to get that tightness. Also, when the buy point is in the green zone, it's okay to have 4 points in the base. Okay. So the question my student was asking is this: see, there are only 4 points in the base. Point number 6 is not yet completed. So point 5 cannot be taken as a buy point, right? So point 3, the high of this candle, which is 385.80. Let me draw that. 385.80. He said, how can we consider this line, which is in the blue zone? How can we consider that line as our buy point? Because it violates two things. Number one, the buy point is in the blue zone, but the latest closing price is in the red zone. So we are buying the stock coming out of the red zone, which is not allowed. Second, there are no 6 points in the base, because if we are buying from the blue zone, there should be 6 points in the base, right? Extremely valid question. So I hope you understood the question. Now I want to answer the question. Okay, this is about two things: risk management and flexibility in your trading. In our system, there are two kinds of criteria. One is the basic criteria and one is the preferred criteria. The basic criteria is we need this blue, green, red, 50-day, 150-day, and 200-day simple moving average. We need blue, green, red, minimum 10 candles in the base, minimum 4 points in the base. That's the basic criteria. The preferred criteria is we need the blue, green, red. We need the price above the blue, green, red. We need all the moving averages to be sloping up. We need minimum 10 candles in the base. We need the buy point in the upper half of the base. If it is in the blue zone, we need minimum 6 points. If it is in the green zone, it's okay with 4 points, right? Plus, if the buy point is in the blue zone, the closing price should preferably be in the blue zone. If the buy point is in the green zone, the closing price should preferably be in the green zone. I have said that so many times, I can actually recite this thing as a mantra. But if you did not understand what I just said, just rewind the video and listen to it over and over again. Okay. Here, what is happening is the buy point is in the blue zone and the closing price is in the red zone. So I am not saying don't buy this. I am saying that if you buy this, there is more risk than buying a stock which has got 6 point in the base and both the closing price and the yellow line in the blue zone. So consider two scenarios. In one scenario, you have this base where the buy point is in the blue zone closing price is in the red zone. In the second scenario, you have 6 points in the base, the buy point is in the blue zone, closing price is in the blue zone. There is good tightness. From scenario 1 and scenario 2, which one do you think is more risky? Think about it. Pause the video. Think about it. Obviously, scenario 1 is risky. So I look at every stock or I look at every base from the point of view of risk. See, you have to wear the lens of a risk manager. Okay. Just because there are no 6 points in the base does not mean that you don't take the trade. This is where I come to flexibility. You have to become flexible as a trader. Okay. Number one. Number two, in what situations will you allow yourself to take this kind of a risky trade? Okay. Let me repeat that question. In what kind of a situation would you give yourself permission to take this kind of a risky trade? Now, imagine a situation where before taking this trade, you took 3 or 4 trades in which you incurred a net profit. You made money on your past 3 to 4 trades. Maybe you lost in one trade, you made money on 3 trades, or maybe you lost in 2 trades, made money on 2 trades. Net, you came out with a profit. Okay. If that is the situation, tell me one thing, does that increase your ability to take risk on this trade, or does that decrease your ability to take risk on this trade? Obviously, it increases your ability to take risk on this trade. Obviously, it increases your ability to take this trade because you are not risking your money. You are risking the money that you earned from the market. So you are playing with market's money. You are not playing with your money. Correct? Now imagine another scenario where before you took this trade, the previous 3 4 trades, you just broke even or you incurred a loss. Now tell me, can you take this trade, or should you take this trade, or will you take this trade? The answer is obviously no, right? You might want to give the stock some time to enter the blue zone or the green zone, by the way, which it did. I will show you the stock gave another buy point, which was much higher than this buy point. So, two things I wanted to convey in this video. Number one, risk management. This is a risky trade. Okay, this is by far a very risky trade because you are buying off the red zone. Okay, and preferably you would want to take this trade when the overall market is in a confirmed uptrend. Remember market condition in our orange trading system, right? Remember that model. I will not show it here, but preferably you would want to take such kind of trades when the market condition is confirmed uptrend as per market smith, and you have made some money at least in your previous 3 4 trades, so that you can use that profit to finance the risk on this trade because you are buying this stock early. There is a lot of overhead supply between the current closing price and point number one in the base. Now let's see what happens after you take this trade. The stock breaks out on high volume, so the trade has worked in your favor. You get price confirmation, you get volume confirmation. If we wait for the next C, now you have another buy point. So let me draw it. So now let us look at this same base from a risk management point of view. So there are 4 points in the base, correct? Now the high of this candle, which is 399.95. 399.95. Okay. Now your buy point is in the green zone and your closing price is in the blue zone, which is not ideal. You want both the lines to be in the green zone. But tell me one thing, which buying price is more risky? Now we are talking about the same base. Now I am not talking about two different stocks. One stock has got 6 points with the buy point in the blue zone, and another stock has got 4 points with the buy point in the blue zone. Okay. I am not talking two different stocks. I am talking about the same stock, same base, two different buy points. You tell me which one is more risky and which one is less risky. Obviously, the closer you buy to point number one, closer you buy to the high of the base, the lesser is the overhead supply. And the lesser is the overhead supply, the lesser is the risk that you are taking. Correct? So this yellow line, if you take a trade at this yellow line, that is a less risky trade than this yellow line because you are buying out of the stock coming out of the red zone. Okay, so the probability of success on this yellow line is more than the probability of success on this particular yellow line. So that's risk management I wanted to talk to you about. Regarding flexibility, I am not saying don't buy at this line. I am just saying that if you choose to buy at this line, then you should buy it with the awareness that you are incurring additional risk. And if you go in with the trade with the awareness that you are incurring additional risk in the trade, only then your mind will take some measures to control risk. Correct? If you don't have awareness of risk, how will you control risk? But if you have the awareness of risk, you can control risk. And what are the two ways to control risk? Number one, small position size. Number two, move your stop loss up. Very, very simple. Correct? So if I were to buy here, I would go in with a small position size. If I were to buy here, I would go it with a normal position size. If I were to buy on this yellow line, I would keep a tighter stop loss, maybe at the low of this candle. If I were to buy here, I would keep a wider stop loss, maybe at 8%. Correct? Risk management. Keep your mind flexible. Look at every base from the point of view of risk. I am not saying don't buy. I am saying you can buy, but buy it with complete awareness of risk so that you can manage the risk on that particular trade, because it is at least meeting our basic criteria, if not our preferred criteria. Now, this is the technical part of the trade. Okay. The same concept of risk management and flexibility could be applied to fundamentals as well. Imagine the stock has some weakness in the fundamental area. Maybe the ROE is not more than 17%, or maybe we don't see ideal growth in EPS or sales. So I am not saying don't take the trade. I am saying you can take the trade, but you should be aware of the risk that you're taking. Unless you're aware, how can you control the risk? We are not changing any strategy. We are not changing our criteria. We are not changing our tactics, nothing. We are not changing anything here. All we are doing is becoming more aware of the risk and adjusting the position size or the stop loss to manage the risk. So again, I want to thank my video course student for asking this fantastic question. I could not answer his question with an email. It's not easy to answer such questions with email because the question itself is very good. Okay, very thought provoking. And it required me to make a video to answer that particular question. And I hope I did justice to that question. Okay. Thank you so much.